Hello, this is Prof. Aram, and in this video I'm going to go over the first financial statement that we will see in this class, which is the balance sheet of the firm. And I will go over each entry in the balance sheet on the left hand side and right hand side and hopefully explain the importance of each. So let's get to it. First of all, what is a balance sheet? A balance sheet is a snapshot of the firm's accounting value at a specific point in time. Usually, as outsiders, we see the balance sheet that is produced at the end of the fiscal year or fiscal quarter. But managers can have balance sheet that is created at any point in time, at any day that they like to see for their firm. Balance sheet is usually a summary of what the firm owns, which is this asset side of the balance sheet, the left-hand side of the balance sheet, and what it owes, which are these liabilities for the firm. And of course, the difference between the assets and liabilities would be the shareholders' equity or shareholder value, shareholder net worth, what is left for the shareholders. So let's get to the first part, which is the asset side of the firm, the left-hand side. Assets are usually classified as current or fixed assets. We have current assets and then fixed assets here. And current assets are usually the ones that have a life of less than 1 year, meaning that they can be turned into cash within a year. Hence, they are called short-term assets. For example, when a firm sells goods and services on credit, they usually collect cash shortly after they sell, and they are going to be recorded as accounts receivables. These are the items that have been sold, but you haven't collected the cash yet. Or you can have inventory. And inventory, for example, is a current asset that usually purchased and sold within a year. Inventory can be in the form of raw material, goods in process, or finished goods. The other group of assets are fixed assets. These are assets that have typically a long life and are either tangible, such as machinery, real estate, fleet of trucks, or factories, for example, or intangible, such as patents and trademarks. The balance sheet's right-hand side represents the firm's liabilities and shareholders' equity. Liabilities are either current or short-term or long-term. Current liabilities, which are these, have a life less than a year. And this means that the firm must be able to pay them within the next 12 months. This is what, for example, accounts receivable is what you owe to your suppliers, and short-term borrowings is what you owe to other creditors such as banks. Firms usually settle these accounts shortly after they receive the goods from their suppliers. Long-term liabilities, on the other hand, are usually paid over a very long period of time. And these include bank loans, mortgages, and bonds. These are borrowings that you had from different sources. You can either borrow from the bank or borrow from public in the form of bonds. Finally, the last item on the right-hand side of the balance sheet is the shareholders' equity. And it is basically the difference between the assets of the firm and the liability, which leads to the balance sheet's identity. Keep in mind, the balance sheet should always balance, meaning that the assets should always equal the liabilities and shareholder equity. The two sides should always balance. So this equation implies that if the firm sells all the assets and use the proceeds to pay off its debt, what is left is going to be shareholders' equity. What is left is the amount that belongs to shareholders. Shareholder equity is also called net worth. So that's why we usually call shareholders the residual owners of the firm. So after you pay everybody else, pay all the liabilities that you have, what is left is going to be for shareholders. Another important thing that we need to pay attention to is the net working capital. This is one of the critical metrics that financial managers pay attention to, which is the difference between the current assets of the firm and current liabilities. Ideally, a healthy firm wants to have a positive net working capital, which means that the cash that becomes available in the coming year is more than enough to meet the short-term contractual obligations of the firm. A negative net working capital can potentially lead to bankruptcy. So this is a super important metric that we all want to pay attention to. In the next video, I'm going to go over an example of a balance sheet and hopefully elaborate on this important financial statement a little bit more. I hope you find this video useful, and thanks for watching.